On August 20th, 2026, America's retail giant released a quarterly earnings report that, on the surface, appeared to be a resounding success. The numbers exceeded nearly every major forecast. Walmart reported adjusted earnings of 81 cents per share, well above the 74 cents analysts expected, while total revenue also climbed past Wall Street's targets. Yet the market reaction was immediate and negative. Despite the earnings beat, Walmart's stock plummeted, losing 9% of its value. This sell-off wiped out billions, driving shares down to $103, its steepest one-day decline in 4 years. This reaction suggests that investors are looking past the current profits and focusing on a specific set of data points that point to a cooling economy for the average American shopper. To understand why a profit beat led to a stock crash, we have to look past the headline numbers and examine the underlying health of the business. Analysts focus their attention on comparable sales, a metric that measures revenue growth only at stores that have been open for at least a year. It is widely considered the most accurate way to gauge real customer demand. Here is where weakness appeared. Walmart's comparable sales grew just 2.6%, missing the 3.7% projection. Context makes this significant. 3 months prior, growth was 4.1%. This sharp deceleration suggests earlier momentum is fading. For a company of Walmart's scale, a slowdown of this magnitude indicates that even the most resilient shoppers are beginning to adjust their spending habits. A closer look at the store's demographic data reveals exactly where this pressure is most intense. Rising fuel costs have become a significant drain on household budgets. With national averages for gasoline climbing above $4 a gallon, the immediate cost of daily life has surged for millions of families. This financial strain is reflected in consumer sentiment, which remains at levels typically associated with economic downturns rather than periods of growth. Interestingly, Walmart's total revenue was buoyed by a shift in behavior among the wealthy. Higher-income households are increasingly trading down, leaving premium retailers to shop for essentials at Walmart instead. While Walmart is gaining ground with wealthier shoppers seeking value, its traditional core customer base is showing clear signs of exhaustion, unable to maintain their previous spending levels as costs continue to rise. The reaction from the financial sector remains split, as analysts weigh the long-term dominance of Walmart against these new signs of consumer fatigue. Those who remain bullish point to a $137 price target. They argue that Walmart's ability to attract higher-income shoppers makes this 9% sell-off an emotional overreaction to a single quarter. Conversely, skeptics point to the stock's high valuation. Trading at 40 times earnings, the share price had little room for error, making it highly sensitive to even a slight dip in demand. Beyond the stock price, Walmart's performance serves as a vital economic signal. With 270 million weekly customers, the company provides a real-time window into the financial health of the country. Historically, shifts in Walmart's internal data have served as leading indicators, identifying broad consumer trends months before they appear in official government reports. This crash is significant because it highlights a growing tension in the economy. It is a signal that for many Americans, the cost of living is reaching a point where even the most basic retail spending has to be reconsidered. To keep up with these economic shifts, subscribe to Legacy and Economy and tap the bell icon. We want to hear from you. Do you see this Walmart pullback as a warning for the broader economy or just a temporary blip? Let us know in the comments.